Hello, everyone. I welcome you all into today's discussion. And what we are discussing is still under the tools of monetary policy. But in today's session, we are going to look at the market for reserves. So these are the two things that I'm going to look at in this video. First of all, I'm going to look at demand for reserves and the supply of reserves. That's how to derive the curves. That is what we are going to look at today. And in other videos, we look at the effect of other factors on it. So first of all, let's take note of these three key things. The first one is the federal fund rate, which I have named as IFF. So when we say federal fund rate, what does it mean? Banks all do borrow among themselves. So let's say I am a bank, and I'm in need of funds, and I want to borrow money from my other colleague banks. Then the rate that the other bank is going to offer to me is what we term as the federal fund rate, or some also call it the interbank rates, right? So anytime a bank is in need of loan, sometimes you can go to your other banks and borrow, and the rate that the banks offer that loan to you is what we call the federal fund rate. Now the second key term is the discount rate. Now when we say discount rate, you see sometimes when banks are in need of money or they are in need of loans to satisfy their customers, and they are unable to obtain the loan from the federal fund rate, that is from their colleague banks, they go to the central bank or the Fed for money, right? So when banks also borrow money from central bank, the rate that the central bank charge on the amount that they are borrowing is what we term as the discount rate. And the third thing that we are going to look at is the interest on reserves. If you remember, we talked about required reserves, and we said reserves consisted of what? Required reserves and excess reserves. So aside the required reserves, some banks sometimes do also keep an excess. Now, when you keep an excess reserve, you also earn interest on that reserves, and that is what we term as the interest on reserves. So that IOR. So what we are looking at the ideal situation whereby the interest on reserves is lower than the interest on the federal fund is offering, IFF, and the federal fund rate is also lower than the discount rate, that is the ID. Okay, so now we are looking at the sources of reserves. In our previous discussion, we looked at the factors that can influence our monetary base, and we were particular about what the reserves. So this we are talking about the sources of reserves. Now the first thing that we are looking at about that is non-borrowed reserve, which I've named as NBR. That is the non-borrowed reserves. So non-borrowed reserves, we are looking at the situation whereby the central bank or the Fed decides to use open market OMO, or open market operation activities, to increase or decrease the reserves that we have in our monetary base. Is okay. So for instance, if the central bank decides to purchase bonds using the OMO, what is that? Is it increases our reserves. So the reserve is increasing through non-borrowed reserves, that is through the activities of OMO. Is okay. And we also talked about the discount loans. That's when the central bank also decides to give loans toward banks. Now, when the central bank gives loans to bank, it also increases our reserves. So when that reserves increment, the reserves also turn as the borrow reserves. That is, so what we say borrow reserve is when Fed lends to bank. So when Fed or central bank lends to bank, we are able to increase our reserves. So that reserves coming through what? The money that Fed gives to us is what we term as the borrow reserves. And that increment in our reserves, that comes through the central bank selling of bonds, is what we also term as the non-borrow reserves. So take notice of these two key things. It's very important. Okay, so we are now going to look at the demand for reserves. So we are going to draw the curves. So we are looking at the situation whereby the interest on our reserves is less than the federal fund rate, and the federal fund rate is also less than the discount rate, so the ID. So let's look at the situation whereby you have your so we are looking at, so with the demand for reserve, the question that we are asking ourselves is what happens to the quantity of reserve that we demand if there is change in our federal fund rate, that is when IFF increases. Okay, so remember we said a bank can keep their funds in excess in their excess reserve account, right? It's either you keep your money in your excess reserve accounts, or you give your money out as loan to other banks who are in need of it and earn an interest of IFF. So what we have already discussed in our class, in the class, that there's always a negative relationship, right? So let's see, the curve looked like this. This is how the curve look like. Now, so we are trying to explain why we have this shape. Now, first we said when IF, so this is the initial rate, right? So we have this as we call it NBR, number reserve one, right? It's okay. So let's say IFF. We're looking at a situation whereby IFF increases because we said the demand for the reserves. We're looking at the relationship between what the federal fund rates and that of quantity of reserve that we will demand. So if IFF increases, what happens to the opportunity cost of holding reserves? Now the opportunity cost of holding reserve is the same as what? IFF minus IOR. Is okay. Now, so let's say IOR. So that is if I save my money, I keep my money in as a reserve, I'm earning an interest of what, 5%. And let's say if I decide to give that money out through the federal fund to other bank at a rate of 7%, right? That means then my opportunity cost of holding reserve is what, 2%. What we say of opportunity cost is if I had given out this money that I'm keeping as a reserve to what as loan to other banks who are in need of it, I could have earned 2% rate more, right, on that money instead of keeping it for 5%. So the 2% here in this case represents what? The opportunity cost of holding the money as a reserve. Is okay. So what we are saying is that anytime that when there is an increase in the federal fund rate, that is, if this side goes up, right, then it means the opportunity cost of holding reserve also what? Increases, right? So because anytime federal fund increases and the opportunity cost of holding reserve also increases, then what it means is that anytime that the central bank increases the reserves, banks would rather what? Reduce the amount that they are holding as what? Reserves. So that is if IF, let's say, move from, let's say, 2 to IFF 3, right? That means at this point, the quantity that the bank is holding what? Also falls. It's okay. That is it. So there is an increase in federal fund rate, and because there's an increase in the federal fund rate, it has increased the opportunity cost of holding reserves. And because the opportunity cost of holding reserves has increased, banks rather what? Reduces the amount of money that they are holding as reserve. Now, if let's say we were here and if it falls and the federal funds rate falls, now once it falls, that means the opportunity cost of holding reserves what? Decreases, and because it decreases, and because it decreases, banks decide to hold on more reserves. That is why it increased to, let's say, NB1. Is okay. Now we're looking at this point that we have it as what? Horizontal. Now look at something. If the federal funds falls and it falls up to the point that it even goes below IORR, right? That is the central bank, the federal rate has reduced even below the rate that we are earning on keeping the money as excess reserve. Then there's no motivation or there's no need in what? Giving your money out through the federal, through the interbank rate. Is okay, through interbank, because you've noticed that if I should give out my money that I'm keeping as excess reserve, that I'm keeping as a reserve, as loan to a bank who is in need of it, and it's going to fetch me a rate interest that is, if I keep the money in my bank, then I will prefer keeping the money out as a reserve. At this point, if the interest rate, the federal rate should fall below IOOR, then banks will prefer keeping their money as reserves. That is why we are going to have this horizontal shape. That is, they will keep it infinitely as a reserve. They wouldn't even think of going to give their money out as loan to other banks who are in need of it. So this is why we have the demand for reserve curve to have this shape. Is okay. So at the point where the federal fund rate is in between IOR and ID, we have that negative relationship, which is obvious. Because if IFF increases, the opportunity cost of holding a reserve increases, so I reduce my reserves. Now, if the IFF is below IOR, that is the interest I will earn on reserves, then I will prefer holding my fund as in my reserve and earn an interest that is better than going to give it out as a loan to other bank. Now let's also look at the supply for. Now let's look at the supply for reserves. And we also said the supply for reserve had a shape like this, which I'm coming to explain. It also has a shape like this. It's okay, so I'll call this RS. So why is the supply curve depicting this shape? It's okay. Now look at this. We said we can get reserve from through two sources, right? We had the non-borrowed reserve and the borrowed reserve. Is okay. Now let's look at the situation whereby the federal fund rate is lesser than the discount rate. Is okay. So if the federal fund rate is lesser than the discount rate, that is from this point, any point below the ID, right? Any point below the ID. Now, when the federal fund is lower than the ID rate, then what it means is that the borrowed reserve is going to go at 0. Because if the federal fund is lesser than the discount rate, there's no way banks will move to the central bank and borrow, because they are better off borrowing through the interbank. So anytime that that means anytime that the federal fund rate is lesser than the discount rate, the ID or the discount rate, then the borrowed reserve is equal to 0, because no one is going to borrow from the central bank. They rather borrow from the other bank among themselves. So once the borrowed reserve is equal to 0, then it means then the reserve in this case represent entirely the non-borrowed reserve. I hope it's okay. So at any point where the federal fund is lower than the discount rate, then our borrowed reserve is 0, because banks would not borrow from the central bank. That means the reserve in this case represents non-borrowed reserve, and that is why it is having this shape. And that is why it is having this shape. So anytime, so what we say is as long as the federal fund rate is always below the discount rate, then borrowed reserve is equal to 0, and the supply curve will have a vertical shape like this. It is always going to have a vertical shape, which is like this here. Now, in the situation whereby the federal fund rate is also greater than the discount rate, then what it means is that people would rather also prefer borrowing from the central bank instead of borrowing from other bank, right? So that means at that point, the banks are rather going to borrow from the central bank, and that is why it is also going to have this shape, this horizontal shape at this point. So once the interest rate, federal fund rate exceeds the ID, once the federal fund rate exceeds the discount rate, that means banks would rather prefer borrowing from the central bank, and that would mean that anytime it's above, they have a central borrowing from the central bank, so that is going to give us the horizontal shape. So now, just like a normal economics term, the intersection of the two curves now becomes the market equilibrium. So we can decide to depict both the demand for reserve and supply of reserve in one diagram. So if I draw this is demand for reserves. So let me call it MB1, and this is my federal fund rate ID, IFF, and IOR. Is okay. So we know the demand for reserve will have this shape. We have it as RD, meaning demand for reserves. And we also know that the supply will also have this shape, which is RS, right? So where they are meeting here becomes the equilibrium IFF. Is okay. And then this point also becomes the non-borrowed reserves, right? So this is the diagram depicting a situation whereby the demand for reserves and the supply of reserve meets, right? So at the point where the two are meeting is what we term as the equilibrium points. So I'm going to end here with the first discussion. Now, in the second one, I'm going to look at the effect of open market activities, changing the reserve ratio, and the rest on how these are going to affect the information that we have here. Thank you.